Hello, class. This week we're talking about liabilities. So I wanted to kind of give you my feel of what liabilities are and how they have an important function or an important impact on a business's financials. So for the discussion, we first were addressing what is the difference between a long-term liability and a current liability. So a current liability is a loan that needs to be paid back within a year. So it's short-term debt, and then a long-term liability, of course, would be long-term debt. Would be anything that needs to be paid back in more than a year. So for example, a short-term debt to me personally, in my own personal economy would be and I would never do this, but let's say I decided to buy a TV from Best Buy on credit, and I had to make, say it was $500, and I had to make $500 payments. That would be a current liability or a short-term liability. And then my mortgage that I have on my house is spanned over 30 years. I bought it a few years ago. Hopefully I have it paid off before then. However, since I don't have to have it paid off before 30 years, or I guess 28 years from now, then it is considered a long-term liability. If a business has a lot of short-term liabilities or a lot of current liabilities, then you need to make sure that they're very liquid. In other words, they have a lot of cash or cash equivalents in their assets section of their balance sheet. And that is because they need to be able to meet those short-term liabilities. Otherwise, those short-term liabilities could really add up. And if they can't make the payments, then those organizations, or probably the banks or the credit unions that hold those loans over the business, can actually sue them and collect some of their assets, which is never good for business, not good for publicity. It's just not good from an operational standpoint or financial standpoint. And so you need to make sure that they have a lot of cash equivalent assets, whether it be cash or inventory that can be converted into cash quickly, or some sort of investment like a CD or a mutual fund, to be able to meet those short-term liabilities. Long-term liabilities represents leverage that is over, of course, many years, and so if there's a lot of long-term liabilities, then if those are starting to stack up, that's really going to hinder how a company performs in the long term, which is what most investors are interested in, is how businesses perform over a 10 to 20, 30, 40, 50 year period, rather than just the next 5 years. So anyway, I hope this helps. If you have any questions, definitely hit me up and let me know. If I need to explain anything any further, or I need to give you some more details. So thanks, everybody.